Great. All right. Well, thank you everyone all so much for taking the time to be on our financing for real estate webinar this evening. Looks like we have an amazing turnout for tonight's event, as financing is such a critical part of the real estate process. So in a few minutes, I'm gonna be introducing our preferred lender, Reed Hazard from CMG Financial. Reed and his team have been a critical part of the growth of Marshall Reddick and helped thousands of our clients obtain financing for purchases, as well as leverage refinances to help expand their portfolios and improve their interest rates. So he's going to be doing an introduction on himself shortly and share his 2022 outlook on lending. Before we turn it over to Reed, though, there's always a fair amount of folks that have been to our events in the past, and then there's always a ton of new people. So for those new people, I want to take a couple minutes just to introduce Marshall Reddick and explain who we are and what we do. So Marshall Reddick is a full service real estate firm, and we have 3 services that we focus on. We have our real estate brokerage, our property management, and our private lending. So for our real estate brokerage, we help people buy and sell property, whether that's here locally in Southern California or in one of our out-of-state markets. The next service is property management. So 99% of the folks that buy an investment property are going to need property management. So we cover everything from marketing the property, tenant screening, rent collection, rent disbursement, any kind of repair request. We help the owners do turnovers. We even issue all the tax filing documentation at the end of the year. So we would cover everything from A to Z from an owner's standpoint. Then our third service is actually private lending. So this is very different than what Reed's going to be discussing, but so this is not the conventional type of lending that Reed does. This is private lending. So typically we have 2 clients there. We have our borrowers and our lenders. So typically our borrowers are folks that are looking to do like a fix and flip on a house, right? So short-term financing for maybe a construction project. Another example of our borrowers would be somebody who owns a self-directed retirement account, and they're looking to acquire property within that account. They need what's called a non-recourse loan. We would be able to provide that to them. So those are 2 good examples of our borrowers. On the flip side, we have lenders. So the same way, many folks have invested in rental properties, you actually have the ability to invest in mortgages. So these are first position liens, and you would be able to collect interest on those. Those range anywhere from 12 months on the short end to all the way to 30 years. So that's a little bit more about our business and what we do. And my goal is to make the process of investing as easy as possible. So a little bit more about my role and who I am. So my name is Vince Tomich, and I'm an advisor and real estate agent here at Marshall Reddick. My primary goal is to learn as much as I can about each individual and help guide you through the process to achieve your investment goals. A little bit more about myself. I was born and raised here in Southern California. I have been in the real estate industry now for over 6 years. I am an investment property owner myself and definitely plan on continuing to grow my portfolio. Prior to my role as an advisor, I was actually a mortgage lender for a number of years. And that's where I really learned the value of leveraging money and how important financing is to grow a real estate portfolio. It was just so critical. And once that piece of the puzzle is figured out, it really opens the options for you, whether that be local primary transactions or investment properties out of state. So here is a screenshot of all of the major markets we're in. So technically we're in 16 markets across the country. What you're going to notice here is there are a handful of highlighted cities in green boxes. These are markets where Marshall Reddick has a physical footprint, meaning we have offices, agents, property management, etc. So this is where we have a stronghold, and we can help our investors if they're looking to diversify outside of the market that they're currently in. Now, how did we choose those markets, right? So, we've taken the time to vet out very specific markets that we want to focus on. I think we can all agree that not every market across the U.S. is a good market to invest in. So we've put together some key criteria that we feel that we feel support a strong investment market. And these include, job market, strong job market, low vacancy rates, economic diversity, housing affordability. We love to have, these focus on areas that are landlord friendly, good schools, right? And then last but definitely not least, reliable property management. That's such a key factor in the success of owning real estate, and is managing the property. So that is a big part. So without further ado, I'd like to introduce Reed Hazard with CMG. Reed has done a ton of personal deals with me, and I highly recommend him for all of you future clients that are on this webinar. Awesome guy, works really hard, and I'm going to let him take it away and give us the outlook for 2022.
Awesome. Thank you, Vince, and great to be here with everybody again. We do this particular webinar every year. Also on the Reddick website, under the education tab, there's just a ton of data in there in education, and I've done these every year, and there's a lot of different, articles that I've written as well. So if anybody wants to go kind of back into the past and look at what's been going on with the market for really since the last decline that we had in real estate when the market blew up in 2009. There's data all the way back to then. So definitely go in there, and if you're not exploring the education tab, definitely dig in if you want to know more about any type of subject for real estate. As far as about myself, I specialize in purchase and refinance loans. I've been with Reddick now for going on almost 18 years. Wow, I can't believe it's actually been so long. I bought my first property with them when I was 19 in Altamont Springs, Florida. I've purchased many properties since then. I own property in Austin and San Antonio and in the Orange County markets. And then I'm nationally recognized top producer nationwide. So for loan volume, me and my partner, Al Rodriguez, last year combined, we did about $310 million. And with the rest of our team, we did about $361 million in loan transactions. So $218 million of that was purchase. And we did about 774 deals. So definitely know what we're doing. And, we were able to actually grow last year about 3.3% from the prior year when our industry compressed about 15%. And a lot of that is because we do so much purchase business. And then as far as, for my team and for where I live locally, I do live in Orange County, but I'm licensed in all the Reddick markets. So I do business in all their states. I'm also licensed for my branch in Idaho, Hawaii, Colorado, and Washington, and my company's in all 50 states. But we're the number one mortgage team in Orange County for total loan volume. It's now been going on 4 years in a row now. So again, if you're looking to buy locally as well, people really know our team, and we can be a great resource for you guys, obviously out of state as well, but if you're looking to buy a primary residence. And then another thing that I want to mention is, I do 1 to 4 unit financing. So I get the question all the time about commercial financing. I do know about commercial. I have knowledge on that. But I do 1 to 4 units. So anything that's a conventional loan will be 1 to 4 unit. When you go above 4 units, that's commercial financing. And definitely reach out to me if you need to get a good connection for a commercial lender. So what I'll be covering tonight is getting pre-approved. What does that really consist of? And how does that give you an edge on the purchase market? The best programs available for buying a primary residence, and then the best programs available for buying investment properties. I'm going to be going over conventional, FHA, VA, and jumbo financing. So really what's kind of changed since COVID-19, and really we're pretty much back to normal from where we were at before COVID-19, but I'm going to cover a few outliers on that. Private financing options. So Vince mentioned private briefly, just a phenomenal tool if you want to buy out of a self-directed retirement account. If you already have 10 finance properties and you want to build on that, private financing is an option. So I'll be covering some options there. And then a market update. Everybody wants to know what's really going on with rates, not just what the Fed is saying, but what is really happening with rates on the back end and really what to expect for the next 12 to 24 months. I'm going to give a little bit of a longer outlook and then also cover a lot of really the next 12 months. Okay, so what are the required tasks of getting pre-approved versus pre-qualified? Why is it important? So you complete a loan application. We do ours online. I'll always have a consultation call with you, but I'm going to have you do your application online through my website. It takes 10 minutes. Application the last 5 years has really gotten tight with technology, where I feel like it's almost more accurate when you just do it yourself. But we always have a good consult call. So we'll have the consult call, then I'll direct you to the application, and I'll send you a document request. If you're ready to buy right now, or you're gonna go out there and start shopping aggressively, let us run your credit. Unless you have a recent derogatory on there, or you've had 5 different credit pulls for different reasons recently, and then you have me run it. Unless you're meeting that kind of category, us running your credit should not affect the scores. It just shows that you're shopping for a loan. And if you want to get approved the right way, and you want to go out there and place really aggressive offers, or even just know exactly what you qualify for, we really need to run the credit. So we'll run the credit. We do an AUS approval, where we get you a loan number, and then we actually run your loan through our automated underwriting system for where the loan is going to be sold. So you'll make your payments to my company after closing. CMG is a loan servicer, but the loan is being sold in the secondary market, and it's going to end up with Fannie Mae or Freddie Mac if it's a conventional loan. If it's an FHA loan, it'll go to FHA. If it's a VA loan, it'll be still serviced by us, but it's transferred to VA. So depending on where it will be sold, we run that AUS. We get the income and asset documentation, and then my main production manager that works with you on the front end, Mike, he is an underwriter. He's been underwriting loans for about 30 years. The underwriter is the person in the process of doing a loan that makes the decision, that goes in there and verifies the income, the assets, the credit, right? Verifies everything, and then makes sure that it checks that up against the guidelines of the loan program, and then gives the approval. That's the underwriter. That is my upfront assistant. He is an underwriter. I did that a long time ago because that provides the best level of insurance for you as a buyer and for me as the loan officer that you could possibly have. So it's more expensive to do that, but I do a lot of business, so I'm able to still make great money, but provide really this dream system where I have rates that are as good, if not better, than the biggest banks. So after you do this process, this will be a pre-approval, and you could go and write an offer. We could do an 18-day close after we get you fully approved. I want to say 14 because we've done that, but it's just not realistic. 18 is definitely realistic. You can get the appraisal done. You can get the deal closed within 18 days. And the only market in the U.S. that we cannot do an 18-day closing right now is Texas, and maybe Florida, and maybe Tennessee would maybe need 21 as well. But Texas, definitely 30 days. Any other market, we can make it happen now in about 18 days. I already covered, some of the reasons why it's important, but really understanding what your true buying power is. If you're like, Reed, I want to build a portfolio of 7 rental properties or 10 rental properties. Or Reed, I have $400,000. How much property can I buy with this? And then what do the rates look like? Well, I could tell you if you had $250,000, you could buy $1 million worth of real estate with 25% down. Here's what the rates would look like. And we can really verify that for you. Then when that gets approved and we verify it, your real estate advisor, Vince, or whoever you're assigned to, they are included on that email of approval. They contact you, and then you guys really dig into what you guys are going to buy and where you're going to buy it, and then what that time frame is going to be exactly. Then we get you to the key players in those markets. We get you to the realtors in those markets, and then you start reviewing actual properties. But again, knowing what you guys qualify for, building that game plan. And if it's a primary residence, many potential buyers have incorrect expectations of what their buying power is. They're either looking too low or they're looking too high. And really just finding that out, and especially with rates, how they've increased a little bit recently, very important to see where you guys stand if you're serious. Obviously, sellers will not consider you a legitimate buyer if you've not taken the time to get approved. So the days of going and getting into contract without a pre-approval letter, if you're not buying all cash, pretty hard to do that unless it's like an off-market deal where you know the seller or something like that, or it's a family deal. Other than that, you definitely don't put the cart before the horse, go get approved, and then start looking at inventory. And then I wrote this today is, getting pre-approved is like getting insurance for your home buying process. It's insurance for your lender as well if it's done right. Okay, unfortunately, most lenders, they just don't take the time to do all of this. And it is costly if you're doing this all day long and you're not closing anything, right? Or you're not doing a good job with that, and you know your clients are leaving you, then you wouldn't be able to do this and make any money, because a lot of it is busy work until it becomes a transaction. But the product that we're selling and the service that we provide is great. And so I'm doing a ton of business with this process. And I've taken a lot less over time and given it back to the team that I have. So I have the best talent. That's how you scale and grow. But a lot of lenders don't think that way, or they haven't really been doing it long enough, or maybe they just do too much refinance business and not enough purchase. So again, know the lender that you're working with, work with the purchase lender, and again, protect yourself, get your insurance for your transaction, and get pre-approved. And just real quick, commonly asked questions about getting approved. How long is it good for? It's good for 120 days off one credit report, not 90. It's actually 120. If your documents start to expire after a few months, then we'll probably have, you guys send over updated bank statements. All the realtors within Marshall Reddick will ask for that, because we want to submit, when we submit your offer with the proof of funds, we want to have a bank statement that's recent, not something from September of last year when it's April, right? Or even like 2 or 3 months old. We really want it to be like within that month or within at least 60 days. But the credit's good for 120. What if you're not looking to buy for 4 to 6 months? If you just want to have a consultation and talk about debt to income ratios and go over your income and assets, get to know each other a bit, talk about your strategy, that's part of the consultation call that we have. So there's no obligation to get approved, but that consultation call is great, because that's where we kind of cover that, right? And like, what is your real time frame? And I'm happy to give that time. And then from there, we either, have a conversation where I give you something to go with, because you're not ready to buy quite yet, but you have a general idea. And then, or it's, hey, I'm sending you the next steps to get pre-approved right then and there. And sometimes it's, I want to send you everything, but I don't want to run credit yet till I offer. And these are my financials, and I know I qualify, and I want to work with you, Reed, but don't run my credit yet. And I'm fine with that too. So those are kind of the 3 different arenas that you're going to fall into. But I do urge you that if you're serious about buying now, to just let me run the credit and do it. But again, I'm not going to lose your business by saying no to that if you just don't want to do that yet. And how long will the process take to get pre-approved? If you send us everything, let's say I sent you a list this evening and you got us the documents and application by tomorrow at noon, and you wanted to shop this weekend, I could have Mike process the underwrite by the end of the day and get you out a letter. If it's a really complicated file, if you have like 7 investment properties and you're self-employed, and you have multiple corporations, it can take a little bit longer. It can take 48 hours or even 72 hours, just depending on how complete, though, that you send your files. You send us everything on that list, even a difficult file, we can do a turnaround in about 24 hours or less. There's one extra level of approval that I do beyond this. It's on jumbo loans, and it's for local markets. We'll do a TBD approval and issue loan disclosures and get you fully improved a little bit deeper than even the approval that I'm talking about, and that's so we can do a jumbo loan in 15 days. But other than that, if it's a jumbo loan, we don't even have to go that far, and we'll just follow this particular process that I've just laid out. And one more thing I want to point out is, yes, this is good for more than one property at a time. If you are doing a 1031 exchange, I just had a guy, he had a property in Burlingame that he turned into a rental property, and then he moved to Australia and started a business, but the business was U.S. based, so we could still qualify him for a conventional loan. He had about $3 million that he made when he went to sell this property, and we used it. We bought 9 properties through Marshall Reddick in Florida and in Texas. We did all 9 at the exact same time. So we are built to be able to do multiple deals at the same time. If you're going to 1031 exchange and you want to know what that's going to look like, we'll get you pre-approved and show you how much that you can buy. If you simply just want to buy 2 investment properties at once, and you want to buy 2 in San Antonio, or you want to buy, 1 in Tennessee and 1 in Florida, we can do them at the same time. We can do them right, back to back. So we're really set up to be able to do those things and to be able to do them quickly. And I want you guys to meet my team on who will work with you along with myself, where you'll see their name. They may be requesting items throughout the process. That's myself right there on the left. To the right is Al and Lisa. Those are loan officers, and Al's my business partner. But But below you, Mike Lynch, who's my production manager, he works with you on the documentation up front. I also have David Van Vuren that does his same role. And then Jessica Yinger, she's my loan assistant. She handles all the appraisal orders. She communicates with the client and the realtor after the deal goes into processing. She's just amazing. And then Jana handles the last half of the process. Now, I'm involved in this entire process. We do three pipeline updates a week. I have a very specific process with them. And by having them in place, I'm able to close about 35 loans a month in my own name and about 75 loans a month on, between me and my partner and my other sales staff that work on our loans. I'm able to do that because I have extensions of myself. I'm able to be available throughout the process. I'm able to give you, in many cases, much better service than back when I was a one-man band doing 5 loans a month. And again, I've given away parts of my commission and what I make over time to just get the best talent. And I have a brand and operations manager that also handles post-closing so that after your loan is done, you get clear and concise information on how to make your first payment. If you have questions or you need assistance, we're really full service. After you guys get pre-approved, just simple things to do and not to do. After you get pre-approved, like I'm going out this week, I'm placing offers. Don't go apply for any new credit. And if you need to, call your loan officer. It's not that you can't, but just don't do it or call your loan officer unless if you really, really need to. Don't max out or overcharge on your current credit cards. If we have to run your credit again throughout the process, and if you went and used a bunch of your available credit and you let it cycle, maybe you're in a 60-day escrow, and now your score's dropped, then it's going to affect your loan pricing. In some cases, it could blow up your deal. So just try not to use your credit cards too much after you're in process. Don't consolidate any credit card debt. That's just basically saying don't take funds you have that maybe you were going to use for down payment after we verified it and go, oh, now I'm going to go pay off a bunch of debt because I'm approved and I might not need all this money. Keep that money where it's at. The assets that we verified, that's what we verified to get you approved. Don't make any large purchases. The same exact thing. Like if you guys are going to do anything large with any of your money or change anything about your financials, just call your loan officer. The other thing is that you can't use borrowed funds for a real estate transaction. The only type of borrowed funds that you can use are from a home equity line of credit tied to one of your existing properties or from a cash out refinance that was done from one of your existing properties. Other than that, there's no borrowed funds allowed. You can't go borrow money off a credit card or from a bank on an installment loan and use that to go buy a property. Now, if that money went into your bank account and several months went by, when we go to request your documents, we request 2 months bank statements. Well, we don't see any large deposits in there. It's likely that we will have no idea where that money came from. If it's the exact dollar amount in that bank account is what's on your credit report, we'll probably go, oh, did you take this money out on a loan to buy a property? But my point is people have done things where they've borrowed money before and it's seasoned in their accounts and they've used it. But as a general rule of thumb, any large deposits that we see that are in your bank accounts from the last 2 months, we're going to have to source those. So cash from underneath the mattress is not going to work. It's got to be sourced. So just be aware of that. And any large deposits that you guys do put in, as long as they're from I sold stock in Charles Schwab and put it into my BOFA account, that's fine. We can source that. But unsourceable funds, you'll never be able to use those for down payment on any type of property. Things to do, don't go get a new job unless it's W-2 to W-2. If it's W-2 to now I'm going to become self-employed, but I got approved by Reed 2 weeks ago. I decided, man, this great opportunity came up and I'm quitting my W-2 job. I'm going to go self-employed. We will not be able to use that self-employed income till you have 2 years of filed tax returns. Now, if you leave Google to go work at Facebook, or you simply just take, you're working at a dental office W-2 and you go get another W-2 job at a different dental office, that's fine. We can use W-2 to W-2 income right away. We only need 30 days of pay stubs at the new job before you can close on your loan. But again, just try not to change employment after you're in the loan process of shopping, unless you really need to or it's just a great opportunity. And then, of course, call your loan officer and talk to them about it. Keep all existing accounts open. Don't close any of your accounts after we're in process. Stay current on all of your existing accounts and financial documents. I just had a borrower that went 30 days late on a credit because they were not monitoring it. It was an accident, and it dropped his scores into the 630 range from being in the high sevens. So some people, when that happens, if they have mortgages they've had for a long time and they have really solid credit, it doesn't impact the score too much. It goes into maybe the 720s or 30s from the high sevens. This person didn't have really much other credit on there, so it really destroyed the scores, and they're not going to go up now for a long time. So just be mindful of that. Some of the supply chain issues have happened with financial institutions, and they're not as on top of making sure payments are processed as they were before. Credit cards online with Chase and some of the biggest banks are easy because they're well automated. But if it's a smaller company, especially, really stay on top of it right now. I've had people that I look at hundreds of credit reports every year. I have never seen so many creditor mistakes on people's reports as I've seen since COVID. So definitely be on top of that. I recommend, which I have it in a slide here later, I recommend having a credit monitoring system of some type where you are, if anything touches your credit, you're notified right away. Okay, now you've gotten pre-approved. I want to give you guys the back end of how we approve you. What's the science behind these types of loans, these full documentation loans where you have to verify income, assets, and credit? What's behind that? So debt to income ratio. For example, if you make $10,000 a month in W-2 income, let's say the monthly payments for the home you're buying, for principal and interest, property taxes, homeowners insurance, let's say that there's an HOA, any fixed expenses, not water or trash or sewer or any utilities, nothing like that, but the fixed expenses. Let's say that monthly payment is $4,000 a month. Let's say you also have an auto loan on your credit that's $500 a month. And let's say you pay off all your credit cards every month. So you have $4,500 a month of debts based on the home that you're going to be buying. $4,500 divided into $10,000 a month of income is 45%. You'd have a 45% debt to income ratio. For these types of loans, you cannot go above 49.99% debt to income ratio. And then depending on the type of loan, some of the loans require a lower debt to income ratio and some will allow you to go a little bit higher than that. But for conventional, it's capped at 50. And I'm going to cover that here in a few slides. So debts that are included in debt to income ratio, anything reporting on your personal credit. Now, if on your tax returns you show that your business pays for one of those cars or pays for some of those credit cards, we can omit that debt against your debt to income ratio. And that's another part of getting pre-approved. If you're self-employed, especially, without a doubt, before you even start looking at anything, get pre-approved. But again, that's part of what we figure out here when we look at your tax returns is how much income we can also write back in. Now, another thing things that are not included are auto or health insurance, cell phones and utilities, loans that are not recorded against your credit, business loans. Again, if it's tied to an actual EIN number, we won't even probably see it. But if it's tied to your personal credit and used for your business and we can show that, we can omit that as well. So the max debt to income ratios for buying a rental property or a primary residence with a conventional loan, Fannie Mae, Freddie Mac loan, is 50%. And it's very credit score based. As you can see here, the lower the mid credit score that you have, then the lower the debt to income ratio. They want to see that you make more money to offset that risk. Now, conventional loan programs, that's your bread and butter. That's the one you can go to 49.99% debt to income ratio. For Orange County, you can go to a $970,000 loan amount now with as little as 5% down. Nationally, Fannie Mae has now increased their loan limit to $647,000. That's an 18% increase year over year. And I'm going to cover why that is so tremendously important here in just about one or two more slides forward. But just wow, okay? Why conventional financing? Best interest rates for higher credit tier borrowers. Best loan programs available for investment property financing. minimum down payment options for primary residence, and low mortgage insurance costs with less than 20% down. When you put less than 20% down, you have to have private mortgage insurance. This is for primary residence. You have to have private mortgage insurance to insure the lender in case you ever default. That mortgage insurance comes at a cost. The higher the credit you have, the lower the mortgage insurance costs are. If your mid-credit score is above 780, your mortgage insurance is very, very inexpensive, with even as little as 5% down. But on conventional loans, it's very credit-based. If your credit scores are on the lower side, then the mortgage insurance for conventional goes way, way up. And the interest rates are a lot higher. It's much more credit score sensitive on conventional financing. So as you start to go down below a 700 middle credit score is when conventional financing starts to be less attractive and other types of financing become more attractive. Another thing here that is absolutely amazing to me is you can now do up to a 4-unit property. You can do up to a $1.867 million loan amount. That means you could go buy an investment 4-unit and put 25% down minimum and be able to get a loan to almost $1.9 million in an area like Orange County or Los Angeles or the Bay Area or a high price market. That's the Fannie Mae high balance loan limit. That's just amazing to me. Here's what the loan limits were in 2021. So as you guys can see on the left-hand side, nationally, it capped at $548,000, and then in the high-cost markets like Orange County, LA, areas of New York, $822,375. The 2-unit, $1,053,000. The 3-unit would go to almost $1.3 million, and the 4-unit would go to almost $1.6 million. Again, here are the new limits for 2022, all the way to a $970,800 loan amount. That means in Orange County, you can go buy a $1.1 million, you could buy $1,050,000 and put 5%, a little more than 5% down, and you could buy a house for $1,050,000 and get a conventional loan. Just amazing to me that they increased it so much. Now, why is this so impactful? Because of this screenshot right here. This is the Fannie Mae loan limit all the way from 2003 to current. Now, if this was a live presentation like we do many live presentations with Marsha Reddick, I would be asking the audience to get a little feedback here. But I'm going to talk for the audience as well. This is phenomenal. And the reason why is you can see interest 2003, 4, 5, 6, we went to a $417,000 loan amount. Then we ran into the longest recession we've had in real estate for a very, very, very long time, since the Great Depression. As you can see there, it went to 417 and it stayed there all the way from 2006 to 2016 for 10 years. In 2016, wage inflation started to finally grow again. We were about 1.1 to 1.2% annual wage inflation growth. And our GDP growth, our gross domestic production, right, what we produce as an economy, crept out of those dark days of 09, 10, 11, 12, 13, 14, where employment started to grow again and things started to prosper, and we started to, as an economy, produce more goods, and we started growing again. And the Fed wanted a 2% annual growth rate. For GDP, they want to see wages going up around 2%. That's what their target was for a healthy economy. We started to get a little bit closer to that. That's why they started to hike rates, too, around going into the 17 and then 18 arena. Obviously, with tax reform, they raised them a lot. But as you guys can see, when the economy started to do better with jobs, Fannie Mae and Freddie Mac started to raise their loan limits. Now, even in 2018, after tax reform had happened, and the Fed had to raise interest rates at every live meeting. The live meeting is a quarterly meeting. They meet monthly with their decision on whether they're going to raise rates or lower them, but only quarterly is it a live meeting. That's to tell the markets, the stock markets, everybody, give them a heads up that, guys, if we're going to raise rates, it's going to be at one of these meetings, so prepare for it. Now, they raised rates at every live meeting in 2018, and that was to slow down growth. As you guys can see there, as demand tightened because of there not being enough homes to sell, which also happened in 2018, which is happening right now as well, the Fannie Mae loan limit continued to go up. People get so worried about rates going up, now the values are going to fall. It's about jobs. That's what creates appreciation. Now, if rates go to 10%, that's going to definitely slow stuff down. But if rates go to a healthy level again, here's a prime example right here. I mean, no, they didn't increase it 20% year over year like they just did this past year, but they still increased it about 5%. The average appreciation rate over a 10-year period in a solid market is about 5, 6, 7% for real estate. So what's happening right now is we're going back into a normalized market again, well, which is totally different than it was before. And I'll talk about that when I get to the next couple slides. But it's definitely, we want to start going back to more of a normalized 2% growth rate. And that's what you'll start to see the Fed pivoting and moving for. But again, back to the loan limits, one thing on here that stands out more than anything else is they've never reduced the amount that they lend. Even in the worst crisis we have probably ever had in real estate, it would stand right next to the Great Depression. They never went 417, oh, now we're going to reduce that back down to 330. It just stayed at 417 when we had a 10% unemployment rate that ran for a couple years straight and slowly went down. They still didn't reduce the amount that they would lend through Fannie and Freddie on conventional financing. And this type of financing makes up 90% of all mortgages held in the United States. So this is when you see the Fed raising this by nearly 19%, when you see rents go up by 25%, depending on the market year over year, and the values have gone up with that, the one thing you have to look at is what are the guidelines for getting these loans? Did they loosen them? Are they making it easier to qualify right now? Because if they're raising the loan limits and making it easier, that's scary. But they're not. These guidelines are the same as they've been, if not even a little bit more conservative, since they've been since 2012 when Fannie and Freddie really came in and changed lending. And they did that around 2010, but around 2012 is when it got really like full documentation. The guidelines have only loosened a little bit since then, and they have not loosened at all the last 4 or 5 years. They're just raising the amount that they will lend. They're not making it easier to qualify. So they are doing what they need to do to support the demand and wage inflation growth that we're seeing. So just really, really great information. And when I see this, it makes me feel more comfortable. I've got a very sizable real estate portfolio. It's gone up tremendously. I think sometimes, should I just 1031 all this and go buy a big building? Or should I, start selling and taking profit? But when you look at some of the things I'm talking about, it makes you think twice. VA loans, another amazing product if you want to buy a primary residence. 100% financing available with no mortgage insurance. So in San Clemente, we live pretty close to a naval base. So I did about $36 million in VA loans last year. So if you guys are looking to buy with VA financing, you serve our country, you should get the best type of loan. This is the best loan out there for buying a primary residence. As you see here, you can go a little bit higher with your debt to income ratios. You can go to about 57%. This is only for primary residents. And again, you can do 100% financing. Now, what is so phenomenal about VA is there's no longer a cap on the loan amount that they will lend. Now, the bank that you do the loan through, they might not be able to go to $5 million or $6 million. They may have a cap on that. That's what's called an internal overlay. But we're a direct VA lender. I think we're the third largest VA lender in the entire nation. So for us, we have no cap. When you go above $5 million, you need to have some pretty strong financials. But we're not seeing a lot of people buying, VA loans with $5 million sales prices, but it is definitely happening. I know that I did a deal with Reddick last year that was, I think, $2.4 million, 100% financing in Newport Beach. The interest rate was 2.25% for a 30-year loan with no mortgage insurance. So just a phenomenal product. And so know that in your head, if any of you are thinking about maybe doing a VA loan, or selling a property and using your VA eligibility to buy a new primary, maybe because you don't want to put any money down, you can go as high as you need to. FHA financing, again, this is if you have minimum money for down payment, or if you had a short sale or a foreclosure event in the past that was still pretty recent, you may need to go with FHA, even if you can put 20% down. But usually this is for a borrower that has decent credit or maybe has a little bit more poor credit because of one of those short sales or foreclosures or something happened in, 5 years ago that the credit's still pretty bad, but they've got the money for down payment. This is a great home product, especially for getting into a home as a first-time buyer. You can qualify with as little as a 580 credit score. And again, the credit scores, whenever I say 580 or I say 640, everyone on this phone has 3 credit scores: TransUnion, Experian, Equifax. We go off of the middle credit score between the 3. So your middle score, the average between the 3, is 580. If it's 580, you can still get a loan for FHA financing. Oh, I want to mention one more thing about FHA. Duplexes. If you want to buy a 2-unit property and you even have great credit, but you want to buy a duplex and you want to go in and you only want to put 3.5% down, FHA has raised their loan limits to match conventional loan limits in the high-cost markets, not nationally. Some areas of the United States, FHA will not lend to $647,000 with their minimum down payments like conventional will. But in the high-cost markets like Orange County, in areas of Austin, really in Orange County and LA, they will allow 3.5% down to a 1.25-ish loan amount with 3.5% down payment. I have that loan being utilized constantly. I probably have 4 or 5 people in escrow right now that are utilizing that loan. So think about that. It's an amazing program. You can do it with 3 and 4 unit as well. It's allowed, but you have to have enough rents coming in off of the property where 75% of the total rents are enough to cover the total monthly payment. And that's how FHA will allow you. It's a rent rule. That's how they will allow you to qualify for a 3 or 4 unit property with only 3.5% down. The problem is that even with rents going up as much as they have, you haven't been able to find a property since probably 2015 price levels where a property has enough rents coming in on a 3 or 4 unit in the California markets to be able to cover 75%. It's hard to find. It might be out there. And so again, when we get you guys approved, that's something that we can get you approved for. But the one that does not have that same rule is on 2-unit financing. The property does not have to be self-sufficient. You could do 3.5% down all day long. If you want to use a conventional loan and buy as a primary residence, and you want to do a 2-unit, a 3-unit, or a 4-unit, 2-unit requires 15% down. This program, 3.5. 3-unit and 4-unit require 20% down. 1 unit requires 5% down. So again, and then on this program, you can do 3.5% down for a 1 unit or a 2 unit. Jumbo financing. This is for any of your high cost markets where you need to go above the max conventional loan limit, which remember I covered was 647 nationally, and in the high cost markets like LA, Orange County, is 970,800. So any loan amount over 970,800, it is not sellable to Fannie Mae or Freddie Mac. So another investor or bank needs to provide that mortgage where they're going to buy it from a bank like us or from the retail market or Wells Fargo, Bank of America. Same exact thing. They have different terms when you go above 970,800. So those loans require a 700 mid credit score. Most of the programs require you have 12 months of the monthly payment, that you have that in a savings account after closing, right, or in a retirement account. We need to see you have 12 months of payments in reserves in order to qualify. That's what reserves are. How much money is after this deal is done? How much money do I have? Down payment is not going to fall into the reserve category. And these loans, as you can see, they're more conservative. 43% debt to income ratio. Remember, you can go to 49.99% for conventional, 43% for jumbo. Self-employed borrowers, totally okay. And the interest rates, by the way, I get this question a lot. I'm self-employed. Am I going to have a higher rate? Absolutely not. The interest rates are the same for any of these programs that I'm talking to you guys about. Some banks price their loans. Sometimes they have a particular amount of capital they want to allocate to W-2 borrowers or maybe even self-employed borrowers. They might have some special going on. But for the most part, from the Fannie Mae, Freddie Mac, FHA, VA, standpoint, and even jumbo, same exact rates whether you're self-employed or not. The standard has always been 20% down for jumbo, but there is financing available as little as 10% down. Another thing that you can do is you can do a first loan on a conventional loan to a max of 970 or a max of 647 if you're out of state. You can do a first loan to that amount and then a second loan to get you higher. And on that type of scenario, you only need 10% down. So if it's $1 million property and you put 10, let's just for example, if it's $1 million property and I put $100,000 down, hypothetically I could get a loan for $800 on my first and $100 on my second. Well, you can do that same type of a scenario with 10% down all the way to a $1.5 million sales price. So sometimes if your debt ratios are too high to go jumbo, but you need to buy it at 1.5 and you have the income to do it conventionally, then we'll do a first and second loan together. This is why we get you pre-approved, to really see exactly what your options are. Who's this guy? I almost forgot this was in here. This is me when I was probably just turning 20 years old. I've been doing this for about a year, a little bit over a year. I had started working with American Direct Mortgage. That was one of the mortgage companies back in the time, back when I started at Marshall Reddick. There used to be 5 lenders that worked within Marshall Reddick. And over the years, I'm the one that stuck. And this was just me, just really into what I was doing. I love real estate. I've always been so passionate about it. And it's just funny to see me with no beard and got it 19 years old and still doing what I love. Okay, down payment requirements for investment properties. So we're going to go from primary back to investment. If you have 4 or less finance properties, you can do 15% down with as low as a 660 FICO score. If you have above a 720, you can do 15% down, even on your all the way to 7 finance properties. We do not advise doing 15% down. I advise 25% down, but you can do as little as 20% down. And Marshall Reddick generally always says at least put 20% down, but really 25% down. That's really what we advise. And on a 2 to 4 unit property, as you can see there, it requires 25% down. No lender in the United States will provide a conventional style interest rate on a 2 to 4 unit property with less than 25% down. And then when you have 7 to 10 finance properties, to get the 7 to 10, you have to only changes are you got to have a 720 mid credit score, and the down payment requirements are the same, 20% and 25, but there's no 15% down. And what else I need to know to get to 10 finance properties? Why, again, am I mentioning 10 financed? Fannie Mae and Freddie Mac will not qualify you to buy more property if you have 10 finance properties. Now, if you have 10 finance properties and they're all investment properties, or maybe I have 9 investment properties and I live in my primary and I'm going to move out and rent my primary out and buy another primary, you can do that. You can get 11 finance properties. You turn your primary residence into a rental. I have 10 rentals now and 1 primary. So it's not excluding primary, but it is excluding investment properties. You must have 6 months of reserves for each property. And another thing is that remember that we can use rental income on all of your properties that you have to help offset your mortgage payments and your debts that you pay against that property every month. So against those fixed expenses. For example, if a property is going to rent or it's renting for $1,000 a month, we can take $750 and apply that towards your mortgage payment. Let's say your mortgage payment is $750 a month for principal, interest, tax, and insurance, right? And you're bringing in $1,000 a month of rent. Well, we could take 75% of the rents and apply that towards your income. So now that $750 mortgage payment is no longer affecting your debt to income ratios, and you qualify. And then over time, your income, just like owning a business, right? You have a profit and loss sheet, right? You have, all of your income and then all the expenses underneath, and then you have your bottom line. That's what happens when you own rental property. It goes onto a Schedule E on your tax returns. It becomes a business, right? And so you put all your rental income on there every year. With Marshall Reddick, the best part about their management is they're extremely organized, and they don't even run it like for profit because they just want you to come back and buy more property when you go to sell or when you want to buy property and refer friends and family. It's inexpensive, and the service is unbelievable. And they handle all my properties. And every single year, like I just got them today, I got a bunch of 1099s, and then I'm getting all my other tax documents from them, and it shows all the expenses the entire year. Everything's broken out for me. I can just hand it to my CPA. But my point is that by using a management company, you're also going to guarantee that your rental income is always being put on your taxes. You're never going to have a year that your CPA, had no idea how much rent was there. We just didn't put rents this year, but now I need to buy a house this next year, and now I can't qualify because 3 of these houses have no rental income on them, and now my debt ratios are too high, and I have to go and amend my tax returns because I didn't put the rental income on there, just to have enough income to qualify. Like these things happen. They happen all the time, and usually it's when borrowers are self-managing, or when they have some borrowers that self-manage that have no other job at all can do a decent job locally. But that's about the only thing I've ever seen that's ever worked. And usually it's people, though, that are self-managing or that are using poor property management that I see when they come time to qualify. Maybe they're coming out of the woodworks and haven't bought in 5 years, and now we're going to buy some more property, that we notice tax issues. So, again, a lot of that comes back to how you're reporting. If you're reporting everything properly and buying in a great market, like the markets that we represent, you should be able to have these properties debt service over time, where you can continue to buy 1 or 2 properties every few years until you get to 10 and have an amazing portfolio of real estate, which I advise putting 25% down to make sure it's done safely. But again, it's with tools like this. And again, I already covered some of these, but what to need to know to get to 10 financed. It is only 1 to 4 unit properties. You could have 10 fourplexes, though. You could have 8 duplexes and 2 single families. It's not about the amount of doors. It's about the amount of financed 1 to 4 unit properties. And you can purchase or refinance regardless of the amount of financed properties that you own. This loan only pertains to investment property financing. So again, nothing to do with primary. And 15 and 30-year fixed are available for 7 to 10 finance. There is 20-year fixed available below that. Something else that my company can do that I think is amazing is we can refinance your loan based on the amount of years you have left. So if you're like, I only want a 23-year loan, or I want a 17-year loan right now. I have 17 years left on my loan. I have a 5% rate, but I haven't wanted to refinance it because, my God, I'm paying off so much principal now, and I'm just going to keep it. Well, we can do that loan, and you still have 17 years left, but we just drop your interest rate for you. So that is amazing, and that's because we're a huge bank, and I didn't know about that at my last company I was with for 7 years, AmeriFirst, which they were great, but just we were outgrowing them. I needed a larger company that could fund more volume and operate in all 50 states. They couldn't do that. This company I'm at can do that. Things also like principal reduction. If you're like, I want to put $100,000 on this loan that I did with you, Reed, 7 months ago, and I want my payments to be re-amortized or my payments go down to reflect that, but I don't want to refinance again or change my rate. We can do that here. Can do that in my last company. So just a couple of cool tools that Wells and BOFA can do those things also if they still hold the loan or if it's a jumbo loan. So just know that. I have an old loan that's with BOFA that I just did that with. So the biggest banks can usually do it. Smaller banks usually have no control like that. And then how do I purchase if I can't qualify conventionally, or if I want to buy out of a self-directed retirement account, right? Or I want to do a renovation loan, and then I want to refinance it with Reed to do my permanent 30-year loan after I've renovated it, right? Marshall Reddick has the best private financing. They're also the most dependable, and I would contact them in a heartbeat. Here's some of their programs. If you go to marshallreddick.com, click on the Borrow tab, all their programs are there. But again, I in this industry, I see private money all day long. I don't even know how they're giving some of these rates as low as they are. It's just phenomenal. And a lot of it, I think, is just because of their underwriting. They're not doing this on properties that don't make sense. But if the deal makes sense, which again, most of these deals that they're putting together, if you're buying in the right markets and if you're buying in an A, B, or C class, you're going to fall within what they lend on. But again, I've never seen anybody that's as consistent as them and they can get money as quickly. So if you guys can't qualify for my type of financing, definitely contact Marshall Reddick. Patrick Prunny runs their private lending division. And then so frequently asked questions, which I just covered, was the rental income. You can use 75% of the projected rental income to offset your debt. When you're buying a property that's not already on your credit report, we take 75% of whatever the rents are, and then we add that onto your income towards qualifying. And how we verify that is we have a form included with the appraisal, which will show us what 4 or 5 other properties that are similar to your home that you're buying, what those rent for, and then we give you 75% of that amount to offset the debt. Okay, I'm going to go in here to a market update just to talk about rates here for a little bit, what's going on, what to expect here over the next year. This is an average 30-year fixed rate right here that we're looking at right now. Interest rates back in, the early 80s were around 18%. You had the Volcker Act, which was put into place to slow down growth. Near the end of the late 70s, you had the Yom Kippur War, which OPEC shut down oil to the rest of the world. They said, we're not going to give you guys any oil. You also had a great time that had happened after the Great Depression. There was this Enlightenment period that happened where interest rates were at zero with the Fed for over a decade. And all this growth happened. That was the only way to stimulate the economy and get things back on track after World War II. It was just a heavy time that had just happened. So the Fed had rates at zero, and we went into this age of expansion, and everybody was drilling for oil. And towards mid-70s, oil prices started really, really, really going up a ton because the world was getting to max output. And back then, oil filtered into absolutely everything. Right now, the cost of oil still plays into inflation a lot because, it takes oil to cut wood to make a house. Oil's even in your vitamins. It's in a lot of things. So the price of oil, if that's going up, it's a good precursor to inflation coming down the road. If oil prices start going down, it usually means inflation is going to slow down. Well, inflation was out of control after the Yom Kippur War. It went berserk. And the Volcker Act, Paul Volcker, who was one of the old federal chiefs, he recently died. Really sad. But he had quite the job to have to do. He had to navigate the economy through having to raise interest rates all the way to 18% on the federal fund rate. 30-year fixed rates hit about, actually it went a little bit higher than 18%, but 30-year fixed rates reacted by going to 18.45%. Sat there for a little bit, slowly drifted down over time. Again, that happened for a much different reason than this last time that we're starting to see interest rates go back up. But when we look at the 30-year mortgage, that's a totally different environment as well. If rates are 18%, then your CD at Bank of America is probably going to be paying you 12%, right? So I don't see us going back to anything near that level, but I love to show this slide so that you guys can see kind of the flip side of things. Right now, interest rates, people are calling me because interest rates are back at 3.625 or 3.75, and they're like wanting to put, they're like scared, and going like, God, rates are just too high now. And I'm going like, how old are you? They're like, oh, I'm like 28. I'm like, okay, that makes sense. People that are calling me still that are in their 50s or in their 40s, not to discriminate against age, I'm just saying what I'm seeing, they're still calling me in their 60s, even 70s and 80s, and just like, they're still super low. So I'm going to go over where they're at right now, what's kind of driving them. But I want to remind everybody again about how high that rates have been historically and how low that they still really are. So what you're looking at in front of you is the Fannie Mae 2.5% mortgage coupon. We're currently trading off the 3. We may trade off the 3.5, maybe even the 4% at some point soon. But I want to show the 2.5% coupon. That most closely relates to the conventional loans I'm talking about in your own backyard nationwide. This is the loan that 90% of the entire U.S. is financed on. Okay? Now, green, every one of those little candlesticks is 5 days of trading, Monday through Friday. Trades just like the stock market. Green is a day that investors bought the bond, causing the bond to appreciate, which drives down the yield. Rates get better when this goes up. Okay? Red is a day that the selling outweighed the buying, and that the yields went up. So when investors sell the bond, it causes the yield to spike, and it causes the rate to go up. So as you guys can see, the first highlight I have over here, when you're like, oh, wow, that's so high up there, does that mean rates are higher? No, again, that means that's when rates were at the lowest, okay? That's right around when the vaccines had started to be administered for several months, and you started to see some really big data come out. And that data started to tell the United States that, whoa, maybe we're going to be able to put COVID in the rearview mirror faster. And for that reason, interest rates worsened. Then as we got, as the market started to kind of realize what's going on with the jobs market, and that we're still at about an 8% unemployment rate at that time, then the market started to kind of back off. The Fed did not back off on any of their economic stimulus. And really, it's because they did not want in any way, shape, or form to derail the jobs market. That is the biggest reason why they didn't decide to maybe hike rates a little bit earlier than they did, because unemployment was still really, really high. And that's the one thing, as I showed you before, jobs has everything to do with this. So again, they didn't want to derail the jobs market. So they let things ride, and interest rates got better again, almost back to those best levels again. You were at 2.75, 2.875 all day long. Then we started to get in the CPI data, which is the Consumer Price Index data, showing that the cost of goods was still continuing to go up year over year, month over month, at much too fast of a pace. Back around March, April, May, we saw really, really large year-over-year readings in the cost of goods, but that was expected. We shut down the entire economy 1 year prior for almost 120 days. Obviously, year-over-year, we were going to see crazy spikes in the cost of goods because of supply chain issues. But they believed that those would start to really subside going into the third quarter. Okay, but then as you get to the third highlight on my screen, that's when they realize, my gosh, inflation is really not slowing down right now. And on top of that, every time we have another new outbreak due to COVID, it's causing the supply chain issues to get even worse. And that's causing even more consumer price inflation, and will cause more in the future too as we start to open up again out of these not full lockdowns but even partial style lockdowns. It pushes this out even more. Longer CPI, right? Or longer high readings of CPI. And it also starts to create an issue with the labor market because the wage inflation starts to go up dramatically. And then we also start to see around that time that unemployment is dropping dramatically, but there's still a lot of available jobs. And then the picture starts to paint that, oh my gosh, we are in actually a very tight, strong labor market. And then we get a reading this last month that showed unemployment had dropped to 3.9%. We were at 3.6% before the pandemic, but interest rates are still at zero. So all these things start to kind of come together, and it paints a very, very, very strong economy. And the jobs data that we just got that I thought was just phenomenal, it still shows that we're adding about 360,000 jobs a month. It shows that there's 11 million unfilled jobs available, but that we're at sub 4% unemployment. That goes to show that there is a lot of room still for the jobs market to grow. There's a ton of room for it to grow. That is why the Fed is talking about raising rates. That is why they're going to raise rates. That's why it's okay if they raise rates. We've got to normalize the ship a little bit. And the reaction we've already seen of interest rates has already been pretty, it's reacting to what they're saying way in advance. The bond market moves 6 months in advance always. So what does all of this mean? Okay. What does all this mean for interest rates? Now, one thing that they're going to do is they're going to watch inflation data very, 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 very closely. But they're also going to watch the supply chain. They're going to look for any improvement there. And that's going to tell them that longer term inflation will slow that much faster. If the supply chain issues get worse, we go into another lockdown, which in my opinion, I'm going to give you guys my base case in a minute for why it's pretty positive, but I don't see any more lockdowns happening again. Praise God, hopefully. But my point is that if another lockdown did happen, then that would be really negative, right? You would see higher CPI and they'd have to raise rates even more. Now, the base case, though, that I have for rates right now are two reports that just came in today after the Fed spoke yesterday, which is amazing, okay? These two reports are extremely, extremely important. One, GDP for the fourth quarter grew by 6.9%. That means the products that we as an economy produced, we produced 6.9% more in the fourth quarter. The market was expecting 5.5%. Now, if supply chains were getting worse, if they were getting worse, not only would they have gotten much worse in the month of December, but we would have definitely wouldn't have hit expectation. If they were improving in the month of December, of all months when we've had Omicron everywhere, if they were improving, 5.5% coming in expectation would have been great. The fact that it came in at 6.9% and came at a time during Omicron where it was everywhere, it shows the economy is working a lot better actually again. And it also shows that the supply chain issues could already starting to be easing a little bit more than what the Fed knew yesterday when Jerome Powell came out and gave an extremely hawkish testimony on having to raise rates all year. That report wasn't out. The other report that just came out is Apple, the largest company in the world, just reported fourth quarter earnings this afternoon. They topped estimates, but more than anything, what's important is that they noted that supply chain issues were starting to improve, which led to their record month. Tesla said a little bit of the opposite. They could have done more, but who knows what Elon Musk is saying half the time, even though he's an amazing guy. But I mean, you never know. Like, he plays with the market a lot. Okay. This was amazing to see Apple stating that their supply chain issues are starting to improve. Great. And to see 6.9% on GDP for the fourth quarter, both very, very positive, I think, to put together a base case that interest rates will have to normalize again a bit, but that we might not have to push them up too much. And this is the beginning of things that the Fed, that they're going to monitor every single month. They're going to look at these things every single month, and then they're going to have a live meeting every single quarter. And then based on how much inflation is slowing down or is increasing, based on unemployment, based on GDP, which is going to show them a lot about the supply chain, based on COVID and how we're doing there, they're going to raise rates, or they're going to keep them normal, or they keep them the same. But again, these two reports were very, very promising today. Another thing that the Fed is talking about doing is they're going to end their bond buying program that was put in place to support the economy through the pandemic. So they've already been tapering back on that amount every single month. They'll be ending that in March. And then they're also expected to start letting their balance sheet run off over time. Now, that basically just means all these assets that they have put together, right, all the mortgage-backed securities and treasury notes that they've been buying in excess of what they normally would buy, right? They've been buying it in excess because of all of the quantitative easing that they've just provided for the last 2 years, that they're going to let some of that roll off. So as someone pays off their 30-year loan, instead of Fannie Mae rebuying more mortgage-backed securities with that money, they're going to let that roll off that month. That's what it means when they say letting their balance sheet roll off. As that money is paid back, they're not going to use that money to reinvest again. But they're not going to get rid of all of it. They're just going to let it normalize a little bit. They're going to balance it out a little bit. They want to go back to getting us back down to 2% inflation from 6% inflation. And in some cases, some levels of the economy, 9%. Now, why do rates matter so much? Again, every 1% increase in your mortgage rate is a 12% reduction in your cash flow. So that's the reason why. That's why rates are so important. One thing that I want to point out is even though rates are starting to go up and values have gone up, I talked about it earlier, rents have also adjusted. This has been a total market adjustment for many of the reasons that I've talked about on this call tonight. So that's why I believe in it so much, and I'm not really fearful here. It's just more of a normalization that has to take place. Remember, the federal fund rate was at 1.75% before COVID, and interest rates were in the mid-threes. They're in the mid-threes. Right now, the federal fund rate's at 0, and we're above the mid-threes. That's an overreaction because of all things I'm talking about, because we got to get back to normal. This really high inflation's got to calm down. But when you read into that, the federal fund rate going up is a good thing, and the markets will take it that way. And once we see supply chains level themselves out, God bearing that we don't have any more COVID lockdowns, this will all play itself out nicely. And when you get back to having more normalized federal fund rates, you'll probably have really, really great 30-year fixed mortgage rates again. Weekly market update. So for this year, I'm putting together a quarterly update as well that will go out to the entire Marshall Reddick database. And it's going to be basically based on like what to expect for the next meeting, what's going to happen at this meeting, right, coming up. I'm going to put it out before the Fed meets, because there's a lot of data that, like I just talked about, that's being looked at every single month throughout the month, and it could change course. Things could change. So I'm going to put together a very nice one that's going to go out every single quarter to everybody. We also have a weekly market update that goes out every week. If you want to be added on that, just let us know. And it's a little bit more, dummied down, just great information for you guys to follow for the week ahead. YCMG, I already talked about some of the main points. Is really, we're a loan servicer. We specialize in investment property financing. We're in all 50 states. And then, me and my team, we are a purchase lender. But we also do a ton of refinance business. So we can handle both. And then obviously know who you guys are working with. Just, Google our name, look at our reviews online, look at Marshall Reddick's reviews, just know who you're working with. Technology has really allowed us to have a great insight into who you're working with ahead of time. And I'm going to wrap it up here, you guys. Again, my feelings on interest rates, I've really covered a lot tonight. This is an important year to keep your finger on the pulse, to know what's going on. If you're looking to buy, if you're looking to refinance, and the event that things go the other direction and we do get higher interest rates, definitely take advantage of the rates right now. I mean, rates are still super, super low. You're probably in a mid-3, a little bit higher 3 scenario, depending on, how much money down if you're buying a primary residence. You're in the high 3 to low to mid-4 on an investment property, depending on if it's a 2-unit, depending on your credit. So they're still super, super low. So yeah, call me with any questions, and I'm going to give it on back to Vince.
Awesome, Reed. That was so much helpful data and info that's so critical for us to know, like the financing piece to this, because yeah, that's just such a pivotal part of the process. So we appreciate all your feedback. Awesome presentation. Guys, as we wrap this up, I just wanted to touch really quick. We have our Reddick rating ebook. This kind of helps outline our property rating. So as you look through our website, you're going to notice there's a letter indication that rates the property. A lot of this indication, or a lot of this, the way that factor is derived is through the median home price. But this short book kind of goes into detail of how we arrive at those property classes. So this is free. There's the link below to check it out. Also, you're able to find this on our website. I'm going to be doing some follow-up calls tomorrow and through next week. And these are basically our consultation calls that we want to see if get your feedback from this presentation, see if there's anything we can do to help. These calls can be as long or as short as you want. Basically, an ideal call would find out the who, what, when, where, and why. Right? We want to figure out why you may be looking at buying properties, how, right? We want to go over your options, whether it's conventional financing like Reed talked about, private lending, cash, whatever it is. When you're looking to buy, setting your criteria is super important. In what markets, right? All kinds of markets may provide different investment results. And then last but not least is all the key players. So it starts with somebody like myself. We obviously have our lenders like, our lender like Reed, our agents, our property management team. There's so many people that make this process possible. So that's, it usually starts though with having the first kind of consultation call with myself and building off of that. This is my contact information. If any of you want to set up a call ahead of time, feel free to reach out. My cell phone number is there, as well as my email. But I will be reaching out over tomorrow and the next week to get any feedback and see what we can do to help. So we know we went over a bit, but we so appreciate for you guys sticking with us, and we hope you enjoyed the presentation. Thank you guys so much for your time tonight, and thank you so much for Reed. That was an awesome job.
Excellent. Thanks you guys for being on the call tonight, and have an amazing year.
Thank you.